Alright, so we're continuing with our mock test. We are looking at question number 7. Question number 7 is a very important question. Why? Because it talks about internal rate of return. Now, what is internal rate of return? Well, for everybody to understand, internal rate of return can be considered to be a discount factor. At this discount factor, the present value of cash inflow is equal to the present value of cash outflow. Here, you are not required to entirely calculate the internal rate of return by taking in two assumed percentages in this question. Ideally, IRR आपको दो assumed percentages you have to take and calculate. But here they are giving you four options. And what are the four options that this question provides you? 5, 12, 14 and 40%. At this they are saying calculate the IRR. So what are the options that I have? I have 5, I have 12, I have 14 and I have 40%. I will calculate the present value of cash inflow at each of these options and I will check what is the nearest. Now, what do I mean by nearest? First of all, at IRR, the net present value will be equal to 0. What is the meaning of this? Present value cash inflow will be equal to your present value cash outflow. Now, suppose, there is a very important concept here. Suppose there are two percentages. For example, there is a percentage 18% and there is a percentage 20%. Let us say that the present value of cash outflow is 10,000. This is an example. This is not this sum. I am saying that there are two percentages. One is 18% and one is 20%. And the present value of cash outflow is 10,000. Now, when I calculate the present value of cash inflow at 18%, my answer comes 10,010. My answer comes 10,010. And at 20% when I calculate, my answer comes 10,028. For example, now what is closest to 10,000? 18% is closest to 10,000. So my IRR will be 18%. Now, suppose my other option is say 15%. And at 15%, my internal rate of return is coming 9,998. And at 20% it is coming 10,028. Your answer should be 20%. Why? Because net present value should be equal to 0. If I take 15% as my answer, my net present value will come -2. So IRR is a discount factor where the entire present value of cash outflow is recovered. You don't have anything extra. Here, if I compare 18% and 20%, who is, again my question, who is closest to 10,000? 18% is closest to 10,000. That is why what is my answer coming? That is why my answer is coming to 18% per this example. Now let's do the calculations. They are giving us four options. What are the four options that this question provides us? 5%, 14%, 12% and 40%. Now always remember one thing, as the discounting factor percentage will increase, the present value cash inflow will decrease, and as the discounting factor will decrease, the present value cash inflow will increase. That's the concept. Now, the highest present value cash inflow will be at 5% and the lowest will be at 40%. They are the farthest possible alternatives. So right now I will not calculate at those alternatives. These are the very close numerical alternatives with each other. So what I will do, I will calculate my IRR at these two alternatives and I will see what my answer is coming. Now, always remember one thing, you have 1, 2, 3, 4. Now, you can either go by choosing discounting factor of each year and doing a slightly longer calculation, or you can go for annuity factor for 2 years and calculate, which will be a faster proposition. I am doing this by taking the annuity factor. If any one of you students has a doubt with respect to calculation of IRR, how to apply discounting factors, how to arrive upon annuity factors, on our YouTube channel, we have a special video that is kept for application of discounting factors and understanding how to calculate the present values. There's a couple of lectures on this. Please watch those lectures if you have a doubt in this concept. So, what I'm going to do is, for year 1 and year 2, I am going to consider the present value of cash inflow. Remember, net income is not important over here. Net income is not important over here. We are going to be calculating present value of cash inflow. So what is important for me is 6,000, 6,000, 8,000 and 8,000. Now at the rate of 14%, I am making my calculation. Now 1 divided by 1.14 is equal to m plus once is equal to m plus twice, and I press MRC. My annuity factor for year 1 and year 2 comes to 1.6466. So 6,000 multiplied by 1.6466, and on my calculator it's a larger number, so I will take 1.6466, multiply this by 6,000. My answer over here comes 9879.96. So I am going to round this off to 10,000. I am going to round this off to what? I am going to round this off to 10,000. I'm so sorry. I'm going to round this off to 9880. What am I going to do? I am going to round this off to 9880. Please try to understand. Now 8,000 for year 3, year 4. So what will I do? 1 divided by 1.14. First equal to the first year's factor, second equal to the second year's factor. Third equal to is the third year's factor. I feed it in memory. I press equal to again and I feed it in memory. Memory recall 1.267. 1.26705179354 is what I get on my calculator. That whole number I take and I multiplied by 8,000. What is my answer? My answer that I get is 10,136. So 10,136 plus 9,880. What do I get as my answer? I get as my answer of present value of cash inflow 20,016. This is what I get at 14%. So always remember, I am repeating, at IRR, present value cash inflow is equal to present value cash outflow. They have to be as close as possible. At 14%, what is my present value cash inflow? So the answer is 20,016. Now I'll do the same calculation at the rate of 12%. I'll do the same calculation at the rate of 12%. So now I will multiply 6,000 by the annuity factor of 12 for the first 2 years. 1 divided by 1.12 is equal to m plus is equal to m plus. MRC is 1.690051020039. I will multiply this by 6,000 and I will get 10,140. Next, I will take 8,000 and I will multiply it by the annuity factor of 12% for the third year and the fourth year. So 1 divided by 1.12 is equal to first year is equal to second year is equal to third year m plus is equal to fourth year m plus. MRC, I get 1.347298326119. I am writing over here on the screen 1.34729. With the whole number I am multiplying, multiply by 8,000. My answer comes 10,778. The total of this comes to 20,918. At 12%, what is my present value of cash inflow? It is 20,918. Now, who is closest to 20,000? Is it 14 or is it 12? The answer is it is 14. The answer is it is 14. Now, please try to understand. There are the following discount factors. Here it is 12% and here it is 14%. As I increase the factor from 12 to above, the present value will start falling. As you can see, at 12 it was 20,918 and at 14 it is 20,016. It will start falling. So eventually by the time if I go till 40%, my present value cash inflow will be much less than 20,000. And just like if I go behind from 14 to 12%, the present value cash inflow will increase. So when I go to 5%, if I take it at 5%, the answer of present value cash inflow will be much more than 20,000. I don't want to see where I am most profitable. I am not calculating net present value. I am calculating IRR, and at IRR, net present value has to be 0. Please try to understand this. Therefore, as my percentage will increase, my NPV will fall. As my percentage will decrease, my NPV will rise. But I want to catch that percentage amongst these 4%. What are they? 5%, 12%, 14% and 40%. I want to catch that percentage that gives me a value that is closest to 20,000. That is closest to 20,000. And what is coming closest to 20,000? The answer is 14% amongst the options that have been provided to me by the examination. Therefore, what is my answer? My answer comes to 14%. For clarity on IRR, for clarity on discounting factors applications, we have ample amount of content. Please reach out. We will ensure that the same has been provided to you. It is a very simple concept from the perspective of its application, but if you are doing it for the first time and if you do not have clarity on how to calculate IRR, you will certainly find this particular statement slightly confusing. Please remember. Let's go to question number 8. Question number 8. Julie is the senior management accountant for Hazelton Manufacturing. Hazelton Manufacturing is a multinational telecommunication company. In an effort to expand the overseas operations, Hazelton encourages the senior management to offer payment to foreign officials to win business. Hazelton encourages senior management to offer payment to foreign officials to win business. What is the meaning of this? The meaning of this is that company is encouraging its executives to pay bribes. Therefore, tone at the top in itself is unethical. So you have understood that this is an ethics question. This is unit number 6, ethics. It's a theory question. These payments are classified as normal commission expenses. So after you pay the bribe is accounted for as a commission. It is accounted for as a commission. Now, what is a commission, my dear students? Commission is a selling and distribution expense that you pay to an agent to sell your goods or help you get customers for services. Now you are offering bribes to some government officials in your international businesses, and you are calling these bribes, these illegal payments, as commission, means you are calling them as sales expenses. So Julie questioned whether these payments should be classified as commission expense since they appear to be as bribes to foreign officials. Julie discussed the situation with the CFO. He stated that these payments are not illegal and are expected within these foreign countries. Now, there are many countries in the world where there is rampant corruption, where there is a rampant amount of corruption. Let's not take any country's name, but we all know. Look at our neighbor, right? A rampant amount of corruption. So, anything if you have to do in those countries, you have to pay bribes. It is a cost of doing business. Just because in one country paying of bribes is legal, are you going to justify an illegal activity just because it is legal in some part of the world? It's not done. In one part of the world, it is probable that murder is justified. Will you start murdering people in your country? No. In one part of the world, maybe stealing is not a crime. Will you start stealing in your country and your company? You can't. Because we go by an ethical moral code that defines human beings. And paying a bribe is wrong. So, although in these foreign countries, this might be a normal practice, in the United States of America, why United States of America? Because we are becoming US CMAs, please. So, we will go by American law. In America, paying bribes is not accepted. So, the CFO says that this is not illegal, and in these foreign countries, this is what happens. Chalta hai, hota hai, koi problem nahi. So, when all the employees are hired, they are required to sign a company code of conduct. In addition, the company provides an annual ethics training to all the employees, and each employee is evaluated based on compliance with operational goals and ethical expectations. When you join this company, it has its own rules and ethical code, moral behavior, model behavior, do's and don'ts. Every company employee is given a training. You can't just join the company and start working and start taking a salary. You have to be in their value system. For example, there are many firms within India's financial sector where carrying non-veg food in your tiffin is not allowed. Say for example, if we talk about big Indian chartered accountancy firms, the chartered accountancy firm, very famous, Chaturvedi and Shah, it's a part of the Next Time network. They believe that you should not eat non-veg, so employees are not allowed to carry non-veg food in their tiffin. Nothing wrong. I don't feel that is wrong. I am a hardcore non-vegetarian myself. I eat non-veg almost every day. But if that company believes that non-veg food is bad, you should not carry it. And if I am working in that company, in my tiffin, I will not carry non-veg. I will carry pure vegetarian food. Why? Because I have to abide by the rules of that company because I am working there. At home, I can eat what I want to eat. Outside, I can eat what I want to eat. But in my tiffin that I carry and I eat in my company with my colleagues, Will I carry non-veg food? No, I will not. Why? Because it is a company's code of conduct that you cannot carry non-veg food in the tiffin. Whose code of conduct? Company. And I've been told to follow it. So as a non-vegetarian, despite being a non-vegetarian, will I carry non-veg food? No, I'll carry only vegetarian food if I'm working for such a company. The company provides an anonymous whistleblower hotline. What is the meaning of anonymous whistleblower hotline? You find anything wrong in the company, you find something bad is happening, you find something unethical is happening, illegal is happening, contact your superiors immediately. Your identity will be protected because it will be kept anonymous. Anonymous means identity is protected. An anonymous whistleblower hotline is provided to the employees to report concerns to the management if there are any concerns. Meaning, as I said, anything wrong, unethical, illegal, etc., you can report it to the management. Julie believes that the company she works for, it has an ethical organizational culture. Identify where this company needs to improve on terms of ethics. Identify where it needs to improve on the terms of ethics. Now let's clear this. Let us read and justify each of these options. The whistleblower hotline provided is anonymous means you should improve it. No. Always remember a whistleblower's identity. Always remember that a whistleblower's identity must be protected. Any whistleblower hotline must be anonymous. If this anonymity is lost, your ethics are compromised. So, do you need to improve over here? Here, no improvement is needed. Here, no improvement is needed. All employees are required to read and sign a copy of the company code of ethics. Yes, this is model practice. Yes, this is model practice. Why is this model practice? Before joining, every employee, before joining, every employee is made or agrees to abide by company regulations. If they don't abide by company regulations, they are not going to be employed by the company. Why? You don't want to follow our rules, don't work for us. As I said about Chaturvedi and Shah, I am working in Chaturvedi and Shah, I am a chartered accountant, but I am going to carry chicken tandoori in my tiffin every day. But the company's rule is that you have to not, you cannot carry non-veg food in the office. It's a pure vegetarian environment. Will you still forcefully, zabardasti, will you take non-veg with you? You can't do that. You can't do that. You have to respect their rules. You have to respect their limitations. You have to respect their way of life. Therefore, before you join, you have to sign the model code of ethics. Here again, there is no improvement that will be needed on this regard. Why? Because signing this model code of ethics before you join is extremely important. So what will I say over here? I will say over here, no improvement is needed. Next, corporate culture allows for improper accounting classification. This must change. This must change. You are giving a bribe and you are showing it as sales commission. Tomorrow, you will do some other bigger crime, such as you will pollute the environment with your industrial waste and you will call it packaging expenses. Correct? Just because a member of parliament or a member of Congress is against you, you will pay another member of Congress to defeat him in election and you will call that preliminary expenses. All this rubbish cannot be done. A bribe is a bribe, clean as day. You call it anything. It's a bribe. It can't be classified as an commission expense. Therefore, the corporate culture which allows for improper accounting and classification must be improved. What should you do with such a corporate culture? Such a corporate culture must be improved. I hope you are able to understand this statement. Employees are evaluated on compliance with operational goals and ethical expectations, obviously. how good are you going to work in the company, how good are you at your job, and what are your behavior culture patterns. You might be a very good professional, you might be a very good professional, but your treatment and your behavior towards women might be very derogatory and bad. Will they employ you? They will not employ you. Google a Indian software wizard, a Indian software genius by the name of Fanish Murthy. He achieved operational goals beyond expectation. One of the best software engineers the country has produced. But he was thrown out of every company that he was a part of, whether it was Infosys, whether it was Patni Computers, he was thrown out. Why? Because of his behavior towards women, because of his behavior and how he used to behave with female colleagues, they threw him out. So, operational goals, yes, you have to satisfy the operational goal. Ethical expectation also has to be satisfied. Remember, it is not operational goal or ethical expectation, it is operational goal plus ethical expectation. Both have to be satisfied. Again, over here, no improvement is needed. So, where is improvement needed? It is needed for a corporate culture that allows for an improper accounting classification with respect to bribes. Therefore, for question number 8, your answer is option number C. We have discussed each option thoroughly, thereby giving you a logical thought process for trying to get the right option in the exams. We are not doing Kaun Banega Crorepati. Now, we are on question number 9. It's an important question. It is of unit number 2. Question number 9 is of unit number 2. It is of working capital management and short-term funds management. Every alternative in this question has to be calculated. Believe me, it's a very easy question, but it's a very important question as well. The Rolling Stone Corporation, which is an entertainment ticketing service. Sir, give us an example. Book my show. Give us an example. Book my show in India. Is considering the following means of speeding cash flow. What is the meaning of speeding cash flow? Increasing cash flow. Means what should you have? Your cash balance at the end of the alternative should be highest. Which of these alternatives, 1, 2, 3 and 4, give you the highest cash balance, that you have to calculate. Okay. Lockbox system. This cost is $25 per month for each of its 170 banks, and it results in an interest saving of 5240 per month. Now, please pay attention. We will not solve this on the screen. We will not solve this on the screen. We will solve this particular question in our notebook. So, first of all, we are talking about what over here? Let's all pay attention. Let's not break our link. We are talking about the US CMA Part 2 mock test. In this, we are dealing with question number 8. Question number 8 deals with unit number 2. It deals with unit number 2 and it is a sum, it is not a theory question. This is what we are dealing with. Our option number 1 is the lockbox system. Now, what is a lockbox system? I am not explaining because this is a sum and not a theory question. This lockbox system has a cost of $25 per month. It has a cost of $25 per month for each of its 170 banks. How many banks does it have? It has 170 banks. So, $25 multiplied by 170 banks. The cost of this is 4250. Next, it results in a saving. What is the meaning of saving? Saving means inflow. What is the meaning of cost? Cost means outflow. It has a saving of $5240. Please look here. It has a saving of $5240 per month, and the cost is also per month. So, per month, what are my savings or gains or my inflow or my saving or my gain per month is how much? If I use lockbox, it's $990. It's how much? It's $990. I hope you understand this. Now, what is my second option? Now, in my second option, they are giving me a draft system. Now, what is a draft system? The draft system will be used to pay for the tickets refund based on 4,000 refunds per month at a cost of $2 per draft. And this will result in an interest saving of 6,500 per month. Okay, so what will happen? You will make 4,000 refunds per month. You will be charged $2 per refund. So, what is your draft cost? Your draft cost is 2 per unit. For how many units? For 4,000 units. So, it's how much? It's $8,000. And what is your saving in interest over here? Your saving in interest is $6,500. Obviously, your outflow, this is your outflow, this is your inflow. Your outflow is more. So, in this, you have a loss. or you have an expense if you go for which option? If you go for your draft option. Let's analyze the third option. Now, what is the third option in the question? The third option is a bank float. A bank float that will be used for the $1 million checks written in checks written each month. The bank will charge a 2% service fee and the corporation will earn $22,000 in interest. Okay. So, what is the bank service fee? The bank service fee over here, this is your outflow. It is on $1 million that they are charging. Let's write this again. There's an overwriting. On $1 million, they are charging you 2%. So this comes to how much? This comes to 20,000. And they are giving you a saving in interest. That means this is an inflow for you. What is the amount of inflow? The amount of inflow is 22,000. So what is 2000? Dollars 2000 is your gain. So in the first option, what is your gain? 990. In the second option, what is your gain? Sir, there is no gain, there is a loss of 1500. And in the third option, there is a gain of how much? Of 2000. Now I go to the fourth option. Check out the fourth option. Electronic transfer. Items over $25,000 will be electronically transferred. It is estimated that 700 items of this type will be made per month at a cost of 18 each, and it will result in an interest saving of 14,000 per month. Okay. So what is your cost? Your cost is going to be 700 items at the rate of 18 each. So cost is 700 at the rate of 18 per unit. It comes to how much? 1,26,000. Oh, sorry. It comes to 12,600. I'm so sorry. It comes to 12,600. And what is your saving? Your saving is 14,000. Your saving is 14,000. One second, guys. Is this 700? Just a second. 700 multiplied by 18. Yeah, it's 12,600. And saving is straight away given to you by how much? 14,000. 14,000. So what is the net gain over here? The net gain that you are going to enjoy over here is $1,400. So if I was to make a summary, in your lockbox, your gain is 990. In your draft, you have a loss of 1,500. Next comes your electronic transfer. In your electronic transfer, you just made a gain of 1,400. And you had a bank service. or a bank float which gave you a gain of 2,000. Obviously, the most profitable is bank float. You should not go for a draft. Now, let's see what they are asking us. Which of these methods of speeding cash flow should Rolling Stone adopt? They are giving you multiple options. Logbox and electronic transfer only. If I adopt logbox and electronic transfer only, I will miss out on bank float. So that is wrong. Over here, what will happen? I will miss out on gain from bank float. So I won't take this option. Bank float and electronic transfer only. Why only? Why should I go for bank float and electronic transfer only? Why is this compulsion of that? Look here, I have the option bank float and electronic transfer only. Why can't I use logbox also? I am getting a gain in that. Na? You are giving me multiple options. Why not this option? Why not all three options? I want all three options. I'm making gain in all three options. Look here, lockbox, draft and electronic. They're giving you three options. But I will never go for a draft. So let's make this logical analysis. In logbox, let's take a look. In logbox, what is your gain? Logbox, my gain is 990. What is the gain in logbox? 990. Plus, what is the gain in electronic transfer? The gain in electronic transfer is 1,400. What is your income in option number A? 2,300. Now let's go for option number B. They are saying bank float. How much is bank float? 2,000. Bank float is 2,000. And electronic transfer is 1,400. What is the income over here? 3,400. Now third option. They are saying logbox 900. Draft is minus 1,500. And electronic transfer is plus 1,400. So what will happen? Oh, it's not 900, it's 990. I'm so sorry. Let me just correct it. It is how much? It is 990. Just a second. So this will be how much? This will be $890. This will be what? $890. Now fourth option, logbox 990. Bank float. Bank float is 2,000. And electronic transfer is 1,400. So 3,400 plus 990. 3,400 plus 990. What is my answer? My answer is $4390. So what should I go for? I should obviously go for the option number D. This is how you're supposed to apply your mind in the exams. We calculated each one and then we go by the option. The moment students will see bank float, they will click on this. That is not what you click on. See the total. This is 3400, I get it. But what about this option? This 4390 is more now because you took lockbox in it. That is why this is your answer. They want you to choose the most profitable option. So these three put together is the most profitable option. I hope you are able to understand this particular concept. If they ask you, I am giving you an extra thing. If they ask you order of preference, if they ask you order of preference, so obviously you will go for bank float first, then you will go for electronic draft, and then you will go for lockbox. Of course, you will not take the draft because draft is loss making. Because draft is what? Loss making. So you have to keep this much in mind. A good question, and these questions are very, very common in your exams. They certainly come for unit number 2. Let's go to question number 10. Question number 10, again an interesting question. Billy Bob brothers are trying to determine how many car terrarium seats would they have to sell each year to break even. They are calculating a break even point. We are in unit number 3, decision analysis. We are doing break even concept and we are doing a sum. They determined that their fixed cost, is 5,000 and the variable cost per unit is 6.5 per unit. They anticipate that they'll be able to sell the seats at $9 at this current market. The projected selling is for 1800 sets in the very first year. All right. What would be their pre-tax profit or loss in the first year? It is not a break-even calculation. It is a pre-tax calculation. So please try to understand sales minus variable cost is equal to contribution. So your contribution is 9 minus 6.5, which is equal to 2.5 per unit for a total of 1800 units. For a total of how many units? For a total of 1800 units. This comes to 4500 as your total contribution. And your fixed cost you can see in front of you, are 5,000. Thereby this gives you a loss of $500 and this is your answer, loss of 500. Nothing more needs to be said in this question. It's a very simple and straightforward question, very basic, and you get such questions in the exams because here's a secret, this is an exam question in itself. Question number 11. Question number 11. Please refer to the business frauds and fraud triangle video that is there in your learning management system. This video of business fraud has been circulated to you. It is also placed on YouTube. We need not discuss it in our mock right now because we have solved this question along with its concept and placed it separately for you. Please refer to that particular video. Next, I come to question